Well, hello everyone, and thank you for joining the Annuity and Life Source, as well as our guest speaker today for this special webinar. Your time is valuable, and we anticipate that this training will take no more than 45 minutes. There will be time to address some of your questions at the end of this training. Also, feel free to use the feature on the right side of your screen to ask questions throughout. We'll be able to address those questions at the end. If you have questions following the webinar, or you'd like to know more about how to partner with the Annuity and Life Source so that we can support your business, I'll be sharing our contact information towards the end. You'll also receive an email following today's webinar with more information about the Athene Ascent Pro series, as well as ways that you can reach us. Remember that just for attending the webinar this afternoon, you will also be entered into a drawing for an Apple iPad. More details on this later. I'd now like to introduce our guest speaker, Mr. Eric Lund. Eric joins us today from Athene Annuity and Life Assurance Company. He has many years of extensive experience working in the insurance and financial services industry. His comprehensive industry knowledge, market vision, and sound business leadership allow him to effectively identify new opportunities. His broad background of working with multiple distribution channels, including the largest carriers in the world, independent marketing organizations, and retail advisors, give him keen insights into all aspects of our industry. And with that, I'll now hand the training over to Eric.
Well, thank you, Emily. I appreciate that. Good morning, everyone, or afternoon, wherever you might happen to be. And I appreciate, Emily, the many years of experience instead of saying actually how many, because it's quite a few. So I thank you for that kind introduction. And just a quick note, too, for those of you on the phone or on the webinar, if you're doing business with the Annuity Source already, you know why you do that. For those of you who aren't, I just want to let you know that I work with quite a few FMOs in my territory, and I am the Western RVP, so I cover most of the Western states. And I would just say that all of the folks at the Annuity Source, in my dealings with them, have always operated with a high level of integrity. They get it. And so if you're considering or have thought about running your business, for sure your Athene business, but any other as well, I would certainly encourage you to consider them. So without further ado, let's jump into the agenda this morning. Really, I want to talk about three things. 3 new products that Athene has introduced, 2 new index strategies, all brought to you by one great company. So really what Athene has done within the last, this has been about we're in about week 3 right now. We have launched 3 new products, well really 2 new products and 1 new group of strategies. But let's just briefly cover what those 3 are or entail anyway. The first is we have brought back multi-year rate guaranteed annuities. We have been out of that market for a couple of years, and we just launched a very, very competitive lineup of MYGAs, and I'll cover how those work and what the rates are in just a minute. Secondly, we have added a couple of new index strategies, uncapped index strategies to our Performance Elite product as well as the Ascent Pro. So these are very, very compelling index strategies that I think are worth your consideration. And last but not least, the product that everyone is very excited about right now is brand new Athene Ascent Pro, which we're very delighted to say is the market leader in both guaranteed, so the traditional level, guaranteed level income, as well as stacked income. And I'll cover how all of that works shortly. So briefly with the 2 new strategies, and I'm not going to cover these in great detail today. They can be a conversation or a webinar in and of themselves. But Athene has a unique relationship with BNP and Morningstar. And I'm sure you're familiar with Morningstar. BNP is not so familiar here in the United States, but they are actually the 3rd largest bank in the world. So we have built with them, or they have built for us, a multi-asset diversified strategy, which we call the MAD5. It entails equities and bonds in 3 distinct regions, the United States, Europe, and Japan, along with gold and a basket of the Bloomberg Commodity Index, I think agriculture and livestock. And then Morningstar, as you all know, or most of you I assume know, is a well-respected name in the equity research business, and we have crafted sort of a niche dividend yield strategy with them that allows them to select 75 companies from the Morningstar investable universe that are focused on companies that provide high dividend payments and have typically shareholder-friendly policies and very, very strong financials. So that's the extent of what I'm going to discuss today. I'll share with you the caps and rates because they're quite exciting, but that's the story on the strategy. And all of this is brought to you by one company. Now, I don't know how many of you are familiar with Athene, and I'm not going to spend a lot of time talking about us, but we are one of the fastest growing providers of fixed index annuities in the country. We are rated A- by all three rating agencies, with a strong possibility that those ratings will increase. We have always, and I know the folks at the Annuity Source, where I've been calling on them for a good number of years, the story has always been consistent. We run the business as an A-rated business. We always have, and we expect eventually, sooner hopefully rather than later, that we will achieve at least an A rating because that's what's warranted. We're a $67 billion company. We have no debt. But most importantly, I think for you to understand on the call is we are a fixed annuity only insurance company. That's all we do. We don't have life insurance. We don't have long-term care. We don't do health. And obviously there's nothing wrong with any of those product lines, but we believe our expertise is in the fixed annuity space. So we are focused like a laser beam on fixed annuities. So if that's your business or it's a business you want to explore, I would highly recommend that you hitch your wagon to Athene and at least have it in your portfolio when you're discussing annuities with your clients. So without further ado, let's jump into the MYGA. Pretty simple story. I'm sure most of you are familiar with how they work. We've introduced a 3, a 5, and a 7-year surrender charge period series of MYGAs. Something that is a little unique, these are flex premium products, and we're not really defining it as flex. They're additional premiums, but we will allow customers to add additional premiums to their existing contract at a 1-year fixed rate. So let me make this clear. The initial premium deposit will be guaranteed for the rate declared at the time the policyholder purchases the policy. That's guaranteed if you pick 3, 5, or 7, whatever rate you have, for that sum of money, your initial premium deposit, you get credited that rate for the entire contract period. Any additional premiums go into a second bucket, which has a 1-year rate guarantee, which is declared. The policyholder will know what it is, but each contract anniversary, that 1-year bucket can and probably will change. So important to know how that works, but the benefit of doing that, having this sort of annual policy contract renewal rate, is that we have created true walk-away products. So all of these MYGAs, when the term is up, regardless of whether or not they've made additional premium contributions, at the end of 3, 5, or 7 years, whichever version they choose, the surrender charges are over. There's no 30-day wait. The money truly becomes liquid, and the policyholder has the chance to do whatever you or they choose to do. So they're true walk-away products. These are the rates. So again, you'll see a column for market value adjustment rates and non-market value adjustment rates. Some states have both available. Some states, like California, for example, doesn't allow market value adjustments, so you'll only be able to get the non-MVA version in California and a few other states. I assume most of you know what MVAs are, and in effect, MVAs make the premiums a little more sticky for the insurance company. Liquidity is not always an insurance company's friend. So when we know the money's a little more sticky, we can offer a little more rate. So that's the trade-off. But I think you will concur, if you're at all familiar with the MYGA space, if you look at those rates in the 3, 5, and 7-year column, pretty hard to beat. In fact, I think impossible to beat for an A-rated company, and even some companies that are down in the B ranking. So we have a very, very strong rate story to tell on MYGA. If you're not selling MYGAs, I would strongly encourage you to consider it. It's a great asset gathering strategy. There are some tremendous split ticket ideas that you can deploy using MYGA. Just a quick example, take a 5-year CD, and I will say generously, if you could find a 5-year CD paying 1.5%, which is taxable, If you can follow my math here, you could take someone who had $1 million in certificates of deposit earning 1.5%, take half of that money, so now you're $500,000, invest that in a 5-year MIGA at 290. With tax deferral, you will virtually equal the return that they're getting on the full $1 million in the certificate of deposit. You can then take the other $500,000 and deploy it into a 5-year fixed indexed annuity with great caps or uncapped strategies, and I'll share those with you a little bit later in the presentation, and give them the potential to substantially improve the return that they're getting. So they can't do any worse. So I like those sorts of stories and ideas because I think it enables you to get people, there's $2 trillion at least, trillion with a T, sitting in money markets and certificates of deposit earning abysmal returns. So a great opportunity to take a MIGA story out. And you'll see at the bottom of the slide here, see if I can do this with my mouse, those are the current rates for the additional premiums. Just notice that they're the same currently, but that probably likely will change over time. They could actually be higher at some point than the initial guaranteed rate. So basically, great issue ages. The 3-year will go up to age 85. We do offer 10% free withdrawals, which is another thing that certificate of deposit can't provide. And those 10% free withdrawals you're eligible, the policyholder is eligible to take those in year 1. So basically in the first contract year, which is another awesome feature. Additional premiums we will take from $1,000 up to $100,000 per year. Here are the states. Again, the light blue, Washington, California, Minnesota, Missouri, Pennsylvania, Virginia, those are non-MBA only states. The other dark blue states have both options available. And Alaska also, I guess, is in that category. So, and Hawaii. That's the first time I've noticed Hawaii on this map. Anyway, great state availability. We're basically everywhere, so feel free to knock yourself out. Just be mindful of what state you're selling in and what products are available, as always. Okay, so that's sort of the MIGA story. Pretty simple. I'm going to spend a few minutes talking about Performance Elite, which is Athene's currently Athene's top-selling product. We think sales will probably finish the year around $1 billion in sales on Performance Elite. I want to make it clear this is an accumulation-only story. There is a rider on Performance Elite, and I'll explain briefly what it's for. But when I say rider, people often think income. That's not the case with Performance Elite. When you think Performance Elite, it is only income. There is no rider, no income rider. I'm sorry, it's accumulation only. There is no income option available other than your traditional withdrawals. So very, very popular product, not overly complicated. We do have extremely attractive premium bonuses. We have very, very high crediting rates, which I'll show you in a minute. And most importantly, I think we have some exceptional liquidity features which enable the policyholder to maneuver around and access their funds if they need to. Now, there are some state variations. As you know, every state has rules and regulations regarding issue rates and bonus rates. I'm going to encourage you to forget about looking at these in the middle. Those are state variations. Let's focus on the base product, the Performance Elite 10 and the Performance Elite 15. This is what it's in most states. So the basic difference between the base product, Performance Elite, and Performance Elite Plus is that for a fee, for a 95 basis point fee, you will go from a 4% bonus on the base product, which does not have a fee, to a 9% bonus on the 10-year contract. I think you would be hard-pressed to find another fixed indexed annuity in the industry where you have a 10-year contract with a 9% bonus. Same thing, same story in the 15-year contract. The base contract has a 7% bonus. The plus version, we get up as high as 12, so great bonus story. Here's where it really gets interesting. So again, top of the chart, the top half of the chart is Performance Elite, the base contract. The bottom half of the chart is Performance Elite Plus, which is the version that has the 95 basis point rider. So with Performance Elite, you can withdraw required minimum distributions day one. Confinement and terminal illness waivers are available after the first contract year, and you're eligible for 5% free withdrawals for the life of the contract. Again, not overly exciting on the liquidity front there. The strategies are the same for both the base and the plus product, so the options that you have in terms of investing the money are identical. It's really the bonus and the liquidity that changes. So let's take a look at what happens down here with Performance Elite Plus. You now jump to a 10% free withdrawal, which is available in the first contract year. It's available the day after the policy is issued. So just for a moment, if you'll think, again, I mentioned a 12% bonus. Someone who puts in $100,000 gets a 12% bonus, wants to take a 10% free withdrawal the week after they issue the policy, they can take out, you know, the full 10% of $112,000. We also allow for stacking of free withdrawals. So I like to think of this as sort of 0-20, 0-20, 0-20. So any year in which you do not take a free withdrawal, the following year is eligible for a 20% free withdrawal. You could go 5 years without a free withdrawal and take 20, but if you take any free withdrawal, whether it be 2%, 5%, any free withdrawal, the following year would be ineligible for a 20. You'd be back to the 10. But I think what has really captured people's attention, and by the way, just so you know, the market, sort of the split in business, we're about 50-50 on the 10-year to the 15-year contract, but we skew about 80% to 20%, 80% going into the Performance Elite Plus. And I think it's in large part because of this, return of premium. In the fourth contract year, with the Performance Elite Plus product, the policyholder has the option to walk away free of surrender charge penalties and with their premium intact. They will get the greater of surrender charge value or their initial premium. Unlikely that surrender charge value would be higher after 3 years of accumulation when you consider surrender charges and market value adjustments and fees, the fee being charged, etc. But it's possible. But at a worst case scenario, they can walk away with their premium. And this is great for those potential customers of yours, and you know who they are, who say, well, geez, what if I want to buy a house? What if I get sick? What if I need the money? Well, if you really need it, and you need it badly enough, you're going to forego 3 years of whatever you may have earned, but you can get to your principal at the end of 3 years, beginning in the fourth contract year. So very attractive feature. Here are the strategies, and I want to just briefly, these are pretty basic strategies, and a lot of people have gone away from selling caps because there's a proliferation of uncapped strategies in the market, and we have some great ones, and they're on this chart. But for a moment, allow yourself to think about what this looks like. This is just the straight old Standard & Poor's 500. We've actually got on the 15-year contract a 6% annual point-to-point cap. I would submit to you, again, as Emily mentioned, with my many years in the business, it's actually 35. This is, you know, when caps are at 3%, it's a lot easier to talk about uncapped strategies. When you're up at 6% or even 5%, I think the story, because it's so much simpler, it's the Standard & Poor's 500. Everybody knows who it is. It's a lot easier to explain. You will get up to 6% of what the S&P returns with no downside. Nothing more, and you'll get anything in between. Your policyholder will likely know what their return is before you go in to do the policy review. Not so much the case when you talk about uncapped strategies. So don't ignore these because of some of the sexy stuff that comes along with the uncapped strategies. But for those of you who do like to sell them, Performance Elite has 3 incredible uncapped strategies. The first is the Standard & Poor's Daily Risk Control, which is an 8% volatility target. So think domestic equities, very high volatility target, which basically means more of the customer's money is actually invested in the index. Our 1-year point-to-point, we use a participation rate. It's either 55 or 65, as you can see on the chart. The 2-year point-to-point, this one, we actually use a spread. So it's 175 and 75 basis points. That 75, by the way, is annual. So if you prorate that over the 2-year life of the contract, it's 150 for 2 years. But very competitive spreads on those contracts. And then the last 2, again, I don't want to spend too much time talking about the indexes, but the BNP MAD 5, it's illustrating like crazy, and primarily because of these extraordinary participation rates. This is a great, both of these indexes are great, and the par rates on them are substantial. So very, very terrific illustrations, and this is an example of what I mean by that. Again, what we're looking at here is the 10-year contract and the 15-year contract with their representative participation rates, and you'll see a worst, average, and best case scenario. Athene illustrates in a very conservative manner. Please keep in mind that these are hypothetical numbers. Anytime you're talking about an illustrated rate, you guys know this, it's hypothetical, this is not guaranteed, and I certainly would never present to a customer that they could expect to get, for example, in the Performance Elite 15, 10.7%. That's the best case scenario that we can run over the last 15 or 20 years. However, it's certainly possible, and I think even if you look at the worst scenario we could find, that's still a very, very attractive return. So I'm not going to spend any more time really talking about Performance Elite. I just wanted to give you a taste for it. It's not an overly complicated product. It is our best 10 and 15-year accumulation solution. And I would encourage you, if you like accumulation, and just another side note, you know, the industry last year in 2015, there was $103 billion of fixed annuities sold in all of 2015 through all channels. Only 25% of that $103 billion had an income rider attached. So I know I often get, because I'm out in the field all the time, and everybody wants to talk about income, and it's great. I mean, people are looking for guaranteed lifetime income. But don't ever forget, and this goes back to my MIGA, the emphasis that I put on MIGA as well as Performance Elite, that 75% of the fixed annuities sold in this country are sold without an income rider. So if you're not selling accumulation, if you're not selling protection of principal, you're missing a big chunk of what's out there. Somebody's buying that stuff. So enough said. So with Performance Elite, again, you get great premium bonuses, great crediting rates, and very, very powerful liquidity features. It is available. Actually, I need to update this slide. Oregon is now approved. And Emily, I don't know if we're good on the 15 or not. I'll have to check. But just make sure you state. Yeah, make sure you check your state before you talk about it. And anybody at the Annuity Source can help you with that. I do want to point out one last thing on Performance Elite. Our contract minimum here, and I'm sorry this looks like a 5-year-old's doing it, but it's a little hard to do with the mouse. The contract minimum is $25,000, and we've had a number of cases recently where folks have sent in $24,600. If they come on, why won't you take it? It's only $400 below your minimum. Well, the short answer is we won't. We will not take it. We will not make exceptions, and there are a host of reasons for that. One would be systems. The other is really basically from an audit perspective. If you think about it, the issue of discrimination comes into play. An auditor would want to know, well, hey, if you let this one go through, did everybody that came in wanting to do 24/6 get it? And it's very, very difficult for us to administer. So just don't forget it's $25,000 minimum on Performance Elite, $5,000 on the MIGA, and $5,000 on the product I'm going to talk about now. So let's see how we're doing on time here. We're just right. Okay, so this is the one that has the phones blowing up, and I hope you'll share my enthusiasm and excitement after we get through this. Ascent Pro is a brand new product for Athene. If you're on our website and you see Ascent, there has been an existing product that we've had for about 18 months called Ascent. That is going to go away middle of May. Ascent Pro is a brand new product. It can be purchased with an optional income rider. And I am not overstating the fact when I tell you that there is no other fixed indexed annuity in the market today that will provide you in any deferral period at any age. That's a big statement to make, but I've had more people that I can count try to prove me wrong, and marketers, as Emily can attest to, love to do that. You will find the best level income of any product in the market. Now, I don't know if I'll be able to say that in December, but certainly right now and for next month and for the foreseeable future, we will be. And we also offer terrific stacked income, which I'll cover in a second. So this is really it. I mean, it's pretty simple. We have two options when the customer purchases the Ascent Pro from Athene. Option 1 is your typical plain vanilla guaranteed lifetime income story. There's a 7-year contract. There's actually a 5-year contract as well that has no income rider on it. But for income riders, there's the Ascent Pro 7. We have the Pro 10, which is a 1010 compliant product, and then the Ascent Pro 10 Bonus 2.0. All of these offer 10% simple roll-up rates, years 1 through 10, and 5% simple in contract years 11 through 20. I don't have the payout factors in here because it gets confusing, but know that our payout factors are graduated annually, so they increase by 10 basis points for every year that every additional year the customer has in age. And so this is a basic story, and I'll show you a slide after this one that will demonstrate quite easily how well we do with it. Option 2 is one that I think is a great story if you're not or haven't sold stacking or growing income. Learn the story, understand how it works. I particularly think that purchasing guaranteed level income for life in an historically all-time low interest rate environment is a little bit risky from the perspective of the guaranteed income that you're being shown today is attractive versus today's alternatives. 10 years from now when you actually begin to take that income, I mean, it could be 2, 3, 5, however many years, it may not look so good. So I think from an income planning perspective, I always encourage people to explore the notion of growing income. So listen, option 2 is our growing income story. Here's where it gets very compelling. For the Ascent Pro 7, the crediting rate, there is a roll-up rate. So there's a 5% simple rate in contract years 1 through 20. And in the 10-year contracts, the roll-up rate is 6% simple years 1 through 20, which is different from one of my primary competitors in the market, which has a growing income story, but they have no guaranteed roll-up rate. So it's all on the come. It's all growth. As I'll show you in a minute with option 2, regardless of what happens on the growth side of your annuity, you're still going to have a guaranteed lifetime income. Another important thing to point out is that the 200% participation rate, which is what Athene's going to credit the customer's income account value, 200% of whatever growth you get on the accumulation side gets credited to your income account value. That 200% participation rate is guaranteed for 20 years. I have some other competitors in the market that have higher participation rates, but if you ask them how long their rates are guaranteed for, it might be a year. What's their minimum, how low they can drop it. Sometimes it's below 50%. This 200% participation rate is contractually guaranteed for 20 years. Very, very compelling story. Okay, so let's take a quick look at how option 1 works. It's pretty simple. Again, this is we just picked a 60-year-old and rolled it out for 10 years. Just draw your attention. I mean, you could do the math on these. Here's 5 years of roll-up. You're getting 10% simple on $100,000 after 5 years. That would be $150,000. But guess what? We credit the contract with an immediate 15% income-based bonus. So hence, you end up with $165,000 in income base. Your annual guaranteed lifetime income at this point after 5 years would be $8,250. If you let this roll out all the way to 10 years, we're now with an income base of $215,000 and an annual payment, guaranteed lifetime income of $11,825. And I'm going to stop for a second and just ask Emily, because she runs these things all day long, how that looks.
How that number looks?
Yeah.
That's the most competitive right now. It's very compelling.
Right. Yep. So basically, you can run this same, we could do this same illustration, and in fact, I've done it right here for you. You can take whatever issue age you want. You can take the number, we just did 5 and 10 year deferrals. They could be 4 and 6, 7. It doesn't really matter. As we speak, regardless of issue age or deferral period, the guaranteed lifetime income produced by an Athene Ascent Pro level income option 1 will beat anybody in the market today. We did a couple of comparisons to a few of our competitors, even one we threw in that had a 14-year surrender charge product. That's the second one on the chart here. we still beat them, even with a 14-year surrender charge penalty. So beat them fairly handily in 5 years, and even after 10 years of deferral, we were a couple $100 ahead per year. Okay, so that's option 1. Let's talk about option 2. Again, this concept of stacking income, and I want to draw your attention. Same thing applies here. We have the immediate 15% income-based bonus, but I want to draw your attention to this gold line here. Okay, this is the 6% simple roll-up rate. So remember, with option 2, sometimes when you talk about stacking or growing income, people are worried that, well, geez, I really want guarantee. I want a guarantee. I want to know. I don't want to take a chance. I don't want to take risk. Well, with option 2, because of that guaranteed 6% roll-up, in a worst-case scenario, in this example, 60 to 70, if there were 0 growth, if any of the crediting strategies I'm going to show you in a moment all failed, and they were 0% over 10 years, this is what the customer is guaranteed. $10,239 in lifetime income. Now, does that look great compared to $11,825? No, $11,825 is certainly a better number, but, or however, you know, take a look at this. You know, your average, you know, your worst, average, and best case scenario is some significant opportunity to grow the policyholder's guaranteed lifetime income. Whatever levels you attain here, once you reach that level, that new number becomes guaranteed. You can't go down. So once your income has grown, it doesn't get taken away if you have a 0 year the following year. So the growing income story is one that's very popular in certain parts of the market, and some carriers have done a better job than others of actually telling the story. But I think it's one that's worthy of consideration for anybody who's willing to sort of accept, you know, this as the worst case scenario with the opportunity to get some of this. So I think a very, very, a story that's very, very much worth telling and learning how it works if you haven't sold stacking income before. And if you have, you're going to look at this and go, great, I love this, particularly because of the guarantee. Again, just some examples, different ages. It works great across the board. Obviously, the older you are, the payout factors are higher. But you've got some substantial differences here in terms of illustrated income. I mean, you know, you look out here, these are very, very compelling guaranteed amounts. They're not guaranteed amounts, they're hypothetical amounts, but I think we all would agree that after 10 years, it's highly unlikely that you're going to have 10 straight zeros. And in fact, when we run hypothetical illustrations, the worst that we could find was that income had actually grown to $16,878. Okay, so everything I've talked about to this point about Ascent Pro has focused on deferral. So we're in the deferral period of the annuity contract. Now we get to the point where the policyholder needs to make a decision about taking income. So they're calling you, their agent, saying, you know what, I've waited my 5 years or my 10 years or my 15 years. It's time. I want to take income. What are my choices? Well, we have 3. We've always had 2, and they're the first 2. Level income is what it is. Whatever your number is, you know, whether you've chosen option 1 or option 2, at the point you elect to take income, level is level. That's the amount that you get, and we'll guarantee to pay you that for the rest of your life. Option 2 is inflation-adjusted income, and for inflation adjustments, we will, at the point, and again, this is an election that you make when you take income. You don't need to make this decision when the policy is issued. This comes at the point when the customer actually begins to take income. We will apply, Athene will apply a discount to that guaranteed amount, and then in return, we will provide the policyholder with income that's indexed to the consumer price index, the urban consumer price index, up to 10% a year for 30 years. So this is a fairly typical option on most annuity contracts. Number 3 is the one that we're most excited about, and this is new for us, and it's basically earnings indexed income. So what we've done here is we've provided the opportunity, not required, but the opportunity is there for the policyholder to actually grow their income while they're taking income. So now you've got, you could potentially have growth during the deferral period and growth during the distribution phase as well. So a very, very cool story. It's 100%, the equivalent percentage of the growth on the accumulation side. So if you were to get 5% growth in your crediting strategy, your guaranteed income would increase by 5% as well. And here's what it looks like. So I'm going to leave this slide up for a second so you can look at it. But let's assume, again, we had somebody who was 55, deferred for, just making this up, I don't know, it might say down it's 55 deferred for 10 years. There you go. So at 66, their number, however they got there, is $10,750. That's their guaranteed lifetime income. They could choose option 1, guaranteed level income, and they could stay there for the life of the contract. If they so chose option 3, the guaranteed earnings index, this becomes their new guaranteed number, $9,353. So there's the haircut that I mentioned. So your guaranteed amount is going to drop, in this case by about $1,400 a year. You'll see a little jump here out in year 18, and I'll explain why that happens. But this becomes the worst case scenario. Again, if the policyholder, if there's no growth in the contract after they begin to take income, they're going to be getting $9,353 for 12 years anyway, versus the $10,750. But as we currently illustrate it, with some modest growth in their accumulation account, their income actually grows after they begin to take it. And in the 6th year, that's the crossover point, about year 6, they've actually increased, in this case, hypothetically, their income from $10,750 to $11,299. And that continues to go along as long as they live. And if we all live to be the ripe old age of 89, conceivably, again, here's a story where their income could almost double from what that guaranteed level income was. And I think for anyone who's concerned about the cost of living increasing, this is an incredible option. What's cool about this from my perspective is you can mix and match. You could take option 1, level income in deferral, and option 3, indexed income in distribution. Just for instance, let's say I elected level income, and when I began to take income, the stock market had crashed, and I felt personally like, wow, the market's going to go back up for the next 10 years. I'm in a great position here. There's going to be a lot of growth. Well, you know what? Maybe I was conservative in deferral, and when I started to take income, I was willing to take a chance that the market was going to go up, and I would grow my income along with it. So I've still got a guaranteed amount, but now I'm going to take option 3 when I take income. So you could also go stacked in deferral and not stacked, it's indexed, earnings indexed in the income phase. So you have the choice to do both. You're not stuck or locked into one particular strategy. So enough on that. A couple of the new enhanced features. We do offer a minimum interest credit, and that's what I mentioned here. When this jumps, it's because when we talk about crediting rates, if the contract after 10 years has 0 growth, Athene will credit the contract 10%. So, or a portion of it. If you've only had 5% growth over 10 years, we'll give you another 5. So there's a guaranteed minimum interest credit of 1% a year, but it's paid in the 10th year. So it's a 10% minimum interest credit paid in policy year 11. We have a bailout feature, which basically means that if any of our caps drop below predetermined levels, the policyholder can walk away. And I was very happy to see that we included a 10% free withdrawal as well, which is always a good number. Actuarially, our experience is that most people don't use free withdrawals. So we have a lot of contracts, or we have had a lot of contracts that were 5% because it gives us additional pricing power. The actuaries are going, they never use it, why should we charge them for it? But in reality, as all of you know, it's easier to sell when you've got that safety blanket of 10% free. The contract also has a doubler. Again, pay attention to state details. It can vary. This is a fairly simple concept. It does have some qualifications. The contract can't, or the annuitant can't be confined at issue. They will need to be confined for 180 of the last 250 days. But the income will basically double for 5 years or until the account value goes to 0, whichever comes first. If this can be shared between spouses, which is a nice feature. If it's not used and turned off, for example, if somebody goes in confinement and miraculously comes back out, if they haven't used the full benefit, it's still available to them in later years. Quickly, let's talk about the strategies. So we have sort of the same lineup. We have a fixed account. We have a one-year point-to-point with caps. We have the no-cap strategy with the S&P Daily Risk Control. And then we have the two new index strategies in here as well. Slightly different participation rates, as you'll see in a minute. So that's why I suggest if you're looking for accumulation on the longer surrender charge products, think Performance Elite. If you're thinking about shorter duration, let's look at this just for a minute. I know there's a lot of data on here, but if you just look at the BNP, the MAD5, you'll see that, remember when we talked about Performance Elite, we were at 130 and 160% participation rates? Substantially less, still attractive. 90% for an income product is great, but it's lower. So if you're looking at a 10 or a 15-year contract, or you really want that home run on accumulation, you want to look at Performance Elite, not at Ascent Pro. But I would add that Ascent Pro 5, which has no income rider, or Ascent Pro 7, which does have an income rider, these are very, very compelling participation rates. And look at this. Annual point-to-point caps at 5 1/4. Now, do you remember at the very beginning of the presentation when I talked about a split ticket idea where you took $1 million, put 500,000 of it into a MYGA that paid 2.9% and basically matched the return that the policyholder was getting on the full $1 million in a CD? Why not take them and put the other 500,000 into the Ascent Pro 5 with an annual point-to-point cap of 5 1/4? You know, there's no guarantee they'll get there, but boy, that's a pretty compelling split ticket idea and a great way to move somebody out of a certificate of deposit or money market fund into an annuity. Obviously, there's no FDIC insurance, but you do have tax deferral and you've got the 10% free withdrawals. So very compelling stories here. I think great caps across the board. Here are the bailout rates. They're a little more powerful on the 5 and the 7-year product than they are on the 10. But nonetheless, if those caps drop below that rate, the customer can walk away. And we've got all the other traditional, traditional strategies in here. So with the income rider, the fee, again, just to briefly recap, the 1010 compliant Ascent Pro has a 10% income bonus, and the 2.0 and the 10 bonus select have 15% income bonuses. The rider fee for the income rider is 1%. It's certainly not the lowest in the industry, but I think it's eminently fair for the value that we're providing. And I want to emphasize that word value. There's tremendous value in terms of what we're providing the customer in terms of guaranteed lifetime income or the ability to grow their income. And again, the roll-up rates for option 1 are 10% simple, years 1 through 10, 5% simple, years 11 through 20. And on option 2, as I mentioned, that very powerful feature of having a guaranteed roll-up rate of 5% in the 7-year contract and 6% in years 1 through 20, guaranteed. Availability, we have a few states missing here. The white states currently do not have Ascent Pro, so I can hear a few people already probably going, it's not my state. Well, take heart. I believe, and I'm being told, and I think there's a very high probability that next week, May 9th being the date, I think we're going to fill all these white states in with some color, whether it be blue, gold, or yellow, or green, depending on state variation. But I think we will have Ascent Pro approved in every state except New York next week. So that's great news, and we look forward to that. I can't promise it. We won't know till we get there, but that's what we're hearing, and I think it's a pretty solid probability at this point in time. So good news on the way for those of you who operate in states that currently don't have the product approved. With that, I'm going to wrap it up, and I'm going to turn it back over to Emily, and we'll be happy to take any questions, but I'm going to stop talking, Emily, and turn it back over to you. And thank you all for your time and attention. I really appreciate the opportunity to speak with you today.
Great. Thank you so much, Eric. We do have a couple questions, and just to reiterate for everyone on the call, you can use the panel on your right. There's a questions feature, and we have a couple submitted. So take a second if you want to address something now. If you prefer to address it after the webinar, feel free to give us a call. Our phone number and email are listed there. We're available here Pacific Standard Time to answer any of those questions. So one that came through was, is the Ascent Pro available in Pennsylvania and New Jersey? I think you heard that question addressed there at the end with the state approvals. We are looking for May 9th for all those states that you saw that were white to have approvals. We'll let you know May 9th what those look like. Stay tuned for our video blog and the email that we send on Tuesday. That will announce definitively what version it is. And then again, feel free to give us a call or email to go through specifics of that. Another question was, is the Ascent Pro RMD friendly? Can you address that, Eric?
Yes, it is. All of our products are.
Great. So the client can take RMDs without any penalties. Always a nice feature. Then we've got a question here about the minimum interest credit. Is it 10% after 10 years for all product versions, the 5, 7, or 10? I think that we're speaking here to the roll-up rate. Do you want to answer that question? I think you have a slide that showed pretty clearly how the roll-up rates work.
Do you think it's the roll-up rate or the minimum interest credit?
Maybe we can answer both.
Yeah, sure. So the roll-up rate is 10% simple on the income rider. The minimum interest credit is, that's over on the accumulation side of the account. So think of if you pick the annual point-to-point strategy and you rolled 0 for 10 straight years, so you had no growth, at that point we'll give you a 10% minimum interest credit. On the 7-year contract, it's 7%. So that's how that works. So you would have, and again, if there's a partial gain, somewhere between 10 and 0 will offset the difference. So I hope I made that clear. So again, if you had a, let's just say 1 year in 10 where you were up 5% and the other 9 were zeros, in year 10, or excuse me, in year 11, we would credit the account 5%. So minimum interest credit refers to the accumulation side of the account. The roll-up rate is on the income side, and that is 10% as well. So sorry if that's confusing, but hopefully that answers that question.
Yes, and then like you mentioned, there is no income rider on the 5-year version.
That's correct. But that's a great accumulation product, great accumulation product.
Agreed. We really like this series a lot. We know that it's competitive. We'd love to run you an illustration today, or for those people that are in states that are getting approved on May 9th, give us a call again, send us an email. We'll run you an illustration. We want to compare it with what you're already writing today to see if it does in fact beat that income or accumulation. So again, thanks to Eric for sharing these ideas with us today. Your insights are invaluable. Many of you have questions about how to get started and how you can get access to this. Our team will be following up with you this week. Also call or email us for more information. Our contact information is listed there. For those on the call today, we also have a special limited time offer. We're giving away that new Apple iPad and wireless speaker set, and you've earned an entry just for attending the training this morning. There will be more information about this in the email as well. I hope this training was valuable to those of you that participated with us. The annuity and life source sees real and tangible value to the client, as well as the advisor, with the annuity solutions being offered through Athene. And as you heard, the best time to purchase an annuity for income and accumulation is now. Thank you again to Eric Lund. Give the annuity and life source a call today to talk more about these annuity solutions and that limited time special. Phone number is 800-743-4930. Thank you, everyone, and have a great day.